And welcome to lesson 5 of our microfinance course. Today our topic is on financial services and delivery channels in relation to the microfinance sector. Our learning objectives for this lesson is to explain the challenges involved in mobilizing deposits from the poor, describe collateral substitutes and alternatives used by MFIs, explain why interest in microinsurance is growing and the challenges it presents, describe payment services used by the poor and channels available to deliver financial products, and last but not least, describe credit products for agriculture and explain challenges associated with agricultural credit. Now, when we want to look at saving services in the community, in general, we realize that many poor women and men continue to save informally. Now, they do that because accessing saving services from formal financial institutions often requires time and high transaction costs. Now, on the other hand, banks also find it quite difficult to serve small and often isolated savers profitably, for which reason banks normally or over the years have not really set out to satisfy the poor. Now, in terms of factors that the poor use in ranking services, they place convenience, access, and security over interest earnings. In recent times, formal providers are trying to reach the lower income markets by providing saving services, usually in the form of deposits. Now, it is quite different, however, to mobilize deposits. Giving credit is usually much easier, but to mobilize deposits is very difficult. But if formal institutions are able to provide the saving services, then it's going to improve upon the informal sector opportunities that are available. Now, MFIs that mobilize deposits from the poor should also be in a position to attract very large deposits so as to lower their overall costs and risk. Now, in terms of the credit products that firms or MFIs give, we look at it in terms of the components of the loan. When it comes to the loan, the core components that are of relevance are the size, the tenure, the repayment terms, the lending methodology, the collateral or security, and pricing. Now, as regards the sizing, loans vary based on need and can be as low as the equivalent of $5 from a community-based provider to upwards of 20,000 USD. Now, most microfinance loan terms range from 3 months to 1 year, meaning that they're quite short term, although there are terms that can be up to 3 years or longer. In terms of the repayments, which normally come in installments, they comprise principal plus interest, but there are cases where it can be interest only if the principal is meant to be paid at the end. Now, normally when people have to take loans, the normal sequence is to provide a loan collateral. But when it comes to low-income clients, they often have minimal assets in terms of property, land, machinery, which they can use to pledge for these loans. So in the MFI sector, there are collateral substitutes. This can be grouped as, or can be captured as group guarantees, where normally groups are put together to serve as the social guarantee for ensuring that the loans are repaid. Or we also have character-based guarantees where somebody would have to vouch for character before it is given and also stand as a guarantor to maybe repay the loan in the event of a default. And then also another way to ensure that loans are repaid is to use frequent client visits. Now, there are alternative forms of collateral, which normally means that you must do compulsory savings or also provide other forms of personal guarantees. Now, loan pricing is very important because for any MFI to stay profitable, it must ensure that its revenue will cover expenses, meaning that the operating costs, its loan loss provisions, the cost of raising the capital, plus some surplus to make a profit. So in pricing, you must seek to get a balance between the need, the cost, as well as capturing that within the framework of simplicity and affordability. So when it comes to loan pricing within the MFI sector, it can be flexible, but it's usually more fixed. And then fees are generally charged on the initial amount of the loan disbursed and may be in a percentage form or flat amount. Interest rates can be used or stated using the declining balance method or a flat rate method. When it comes to the declining balance method, interest is calculated as a percentage of the amount outstanding during the loan term. When it comes to the flat rate method, it calculates interest based on the original disbursed amount. Now, some providers within the MFI sector argue that using the flat rate is easier for staff and clients to understand. So let's see an example. In terms of the flat rate method, for example, take it that somebody has taken a 1,000 12-month loan and with monthly repayments, which therefore means that the loan repayment is 100 for the principal, or a flat amount, sorry, of 100, and then the interest rate is 20%. So it means that this loan is 1,000 CD loan at 20% meant to be paid over 12 months. Now, it means that at the point of disbursement, the outstanding balance is 1,000. At the end of month 1, the person makes a flat repayment of 100, of which is split to allow for the 200, which is the total interest payable over the period, split over 12 months amounts to 16.67, and then the 1,000, which is the principal, is also split over the 12 months to give us an amount of 83.33. Now, over the period, you can realize that the total principal payment comes down to 1,000 and the interest payment comes down to 200, which fulfills the interest requirement of 20% on 1,000 over the period of 12 months. Now, in terms of the reducing balance method, based on what we understand from our amortization schedule, then it means we're going to have a fixed payments plan, which requires that we pay 92.63 per month, of which a portion goes to interest and then the remaining balance goes to offset the principal. So we can notice that as the balance begins to reduce, the interest component, which is calculated as a percentage of the outstanding balance, begins to drop. The difference between the fixed amount results in an increasing principal repayment over the period. So this is what gives us this repayment of 1,000 and total interest payment of this. Inherently, you can see that for just about the same loan balance, the reducing balance results in lower interest payment over the duration of the loan. Now, when it comes to the kinds of loan products that are given within the MFI sector, providers do acknowledge that money is fungible. In essence, it means that money can be replicated in various value forms, for which reason providers have expanded their credit product offerings to include more than the standard micro-enterprise loans. Loans are also beginning to be made available for different purposes. So you can have loans for cash flow management, meaning that you take loans to work out your working capital and other consumption issues. You can take loans to look at risk, to deal with emergencies and other top-up issues. And then you can also take up loans geared for asset building and productive investment, so fixed asset loans, leasing, housing loans, etc. Now, another product that is emerging in the microfinance sector is microinsurance. To a large extent, low income people live in very risky environments and are vulnerable to numerous perils, such as illness, accidental death, disability, loss of property due to theft or fire, agricultural losses, and disasters of both the natural and man made varieties. Over the years, they have been ignored, but recently, microinsurance is beginning to reach the poor, unlike other financial services that have already been with the poor for quite a while. Now, why do we need micro insurance? According to Cohen and Sepstad 2006, the loss of an income earner and sickness of a family member is one of their greatest concerns. Even in that regard, it's clear that informal risk coping strategies tend to cover only a very small portion of losses incurred by these informal sector players. So, more often than not, when they do run into challenges, it actually digs them deeper into poverty because they haven't got enough to indemnify them or to restore them to the original positions before the disaster or whatever risk it was. On the average, the products available from typical insurance firms are not designed to meet the specific characteristics of the poor, for which reason insurance becomes a bit more complicated than savings, credits, or other payment services. But microinsurance becomes even more important. But to even provide microinsurance, while very important, it seems to have a number of challenges, which include that sometimes we don't have appropriate insured amounts. There are complex exclusions that also can give problems, and indecipherable legal policy language that is usually beyond the poor or the average informal worker because these people are normally not that literate. Another challenge that tells of the need for micro insurance is the need to educate the market so that they overcome their bias against insurance. Now, even though this informal sector is the most vulnerable when it comes to risks that we face, both man-made and natural, they seem to have a serious bias against insurance. So educating the market will go a long way in ensuring that they do take up micro insurance, which will then shield them from other shocks that hit the market over time. One of the challenges also when it comes to microinsurance and its penetration is the fact that the poor are very skeptical about paying premiums for an intangible product with benefits that they may never claim. Because often than not, these informal sectors see insurance providers as people who are quick to take one's money but slow to pay it out. All said and done, however, microinsurance is a very important service or product that needs to be taken up by the informal sector. Now, let's look at payment services. When it comes to payment services, we can have products in the category of remittances, deposits, withdrawals, other forms of payments to people, and transfers. Now, delivery channels are usually very distinct from the product and the provider. Though the bulk of money transfer in low-income sector consists of remittances from migrants or seasonal workers, the transfers for some of these things are made through POS devices, cards, and then the mobile phone. Now, pricing of services is very important for the informal sector, perhaps even more so important than for other financial services. Now, what is most important for payment services? The time it takes to effect the payment or transfer. Convenience and a sense of security are also very important, both for the sender and the receiver. So in essence, for the average informal sector worker, one, they are interested in how long it takes for certain payments to reflect whether they are sending or they are receiving. And also they put priority for convenience, and also providing a sense of security is also important for them. And even for the senders, to ensure that at any point in time it's convenient to send the money, and then you are sure that this money will not get into the wrong hands. Now, the delivery channels that are usually employed for the payment services include bank branches, ATMs, point of sale devices, mobile branches, mobile phones, agent networks, and internet banking, as may be the case. Now, within the informal sector, agric constitutes a very important business sector, if I should put it that way. Now, without incentives, many private and even public financial institutions have grown increasingly hesitant to fund agriculture because of the risk in it, and especially for the case like Ghana, where agric is mostly dependent on the weather, a lot of firms are not very willing to risk their depositors' funds on businesses that are not under strict control by the investors. So what we have is that there are very significant gaps in the availability of both rural and agricultural financial services. Now, because agric is a critical source of employment for the poor, most MFIs being founded to serve the poor may imply that agric should also be a very important aspect for the MFI sector. However, we find it sadly that financial services for agric have generally remained a very small portion of MFI portfolios. That begs the question whether the MFIs are really seeking to address the needs of the poor. Now, let's give it some context. In terms of agric, government usually intervenes in agricultural prices either through price controls or through import or export restriction. This, to a large extent, also affects the repayment capacity of agricultural borrowers. And in a lot of cases, governments are often tempted to control interest rates for lending to the agric sector, which can be disruptive, especially for those who are lending to them, because then if they have to borrow at higher rates and lend to the sector at lower rates, then it comes back to bite them in terms of negative implications for their profitability. So now it is not necessarily the role of a provider to lend where there's not a market-linked business case to do so. So in essence, it does not make sense for the average financial institution to go borrow at a high price and come and lend to a unit that is not necessarily placed business-wise to take advantage of the facilities. Now, there are even more challenges to providing agricultural credit. First and foremost, farmers often live in areas that are hard to reach with traditional financial services. Secondly, they face climatic and price risks, seasonal demand for products, and fluctuating labor and capital. They also face risks such as drought, floods, pests, or diseases, which are often beyond their control. Now, when it comes to agric loans, they normally require longer terms, and they are also vulnerable to unpredictable and potentially lower returns of capital. All these work against providing agricultural credit. Now, in seeking to address these challenges, sometimes agric loans often require the principal to be paid at maturity rather than throughout the loan. This allows for the farmers to then invest, harvest, sell off, and then pay the relevant principal. And in a lot of the cases, land is used as collateral. But in our case in Ghana, we normally have a lot of problems with land title and property rights, which then works against access to credit. Livestock and equipment are also fairly high risk, and farmers usually also have no proof of ownership, so this also becomes a challenge in the use as collateral. And even more problematic is the poor financial literacy rates of farmers, which also contributes to inefficient agricultural finance markets. Now, looking at agricultural value chain finance, agric lending requires that the risk assessment goes well beyond the borrower to include market dynamics. Now, the ability of farmers to profit is affected by economic performance of individuals and businesses from whom they buy or sell. So the total set of interactions of all these actors to produce a specific agric product is referred to as the value chain. So for the bank that might provide a loan to a large buyer to unlend to those in the value chain. These are the things that they must look at. So normally you find that a bank will end up providing a loan to a large buyer to unlend. So this large buyer will take it on and then unlend to the relevant players within the value chain to produce, and then they buy back, and then the buyer pays the bank back. Now let's look at another product, which is trade finance. Now, trade and product related finance refer to credits provided by traders, input suppliers, agribusiness processors, and buyers. Now, trade finance is traditionally been the most prevalent form of agricultural finance, and especially for small producers. So, in this case, you're getting the finance more from the people you buy from in one way or the other, or from people whose facilities you use. Now, these provide farmers with funds for inputs, harvest, and other needs such as family consumption and emergencies. Now, providing finance directly to micro and small agri producers may not be the most feasible way due to cost and risk. Bill discounting and factoring. Now, there are times where liquidity challenges would give rise to the need to employ bill discounting and factoring. Because in general, sometimes you have input suppliers or agribusinesses selling on credit and therefore now struggling with liquidity. So bill discounting and factoring can help improve their cash flow without them requiring additional collateral. So they put up these bills that are waiting to be paid or inventory as collateral to take on facilities so they can continue with their line of business whilst they wait for the relevant payments to be made, and then they pay to the institution that provided the liquidity arrangement. Now, factoring allows input suppliers or buyers to access funding, which can benefit farmers who receive advance payments for services to be rendered. We also have a case of warehouse receipt systems, which involve tripartite agreement between the producer, the local financial institution, and the warehouse manager. So the stored produce is sold when prices are generally highest and potential revenue can be maximized. So here you have a case where the producer operating on behalf of farmers will borrow using stored produce as collateral. And then the financial institutions which lend to the producers of organizations, and then the warehouse manager who provides a storage facility for the stored produce. Now, when it comes to agri insurance, which is also another product that is beginning to emerge on the horizon, we realize that it is quite common in developed countries, but much less so rather for the developing world. It's because we have challenges with relevant data, ability to verify losses, develop appropriate indexes, and then distribution of insurance products are limited. Now, to a large extent, it is very costly for insurance companies to provide services and very difficult for them to offer prices that farmers are willing to pay. So on one hand, it's expensive for the insurance firms, and on the other hand, farmers are not necessarily willing to pay the premium that is required for providing agricultural services. For which reason, it has become useful to bundle insurance with other financial products like loans and savings products. So we have come to the end of this lesson, and we have gone through a number of issues. Mainly, we have tried to explain the challenges involved in mobilizing deposits from the poor. We've tried to describe collateral substitutes and alternatives used by MFIs. We've also tried to explain why the poor need microfinance and the challenges that microinsurance represents. And then we have also tried to look at payment services used by the poor and the channels available to deliver such financial products. And then we also tried to look at credit products for agriculture and explain the challenges associated with them. Thank you for your time. See you with the next lesson. Bye.